So I've been investing £10 every single day into the S&P 500 for 120 days straight now. And this is how it's going. So I decided to invest into one of Trading 212's cheapest S&P 500 funds, the SPDR S&P 500 UCITS Accumulating Fund. Now this fund tracks the S&P 500 in a very similar way as the others do, for example from the likes of Vanguard and iShares. However, this has an expense ratio of only 0.03%. Now this ETF is also an accumulating fund, meaning that the dividends that are paid out from holding the companies in this fund, they are reinvested back into the fund, so you're not going to get paid out dividends for holding this fund. In either case, on the 12th of May 2025, I started investing £10 every single day, and as you can see, it wasn't long after the crash that we saw, the flash crash, which was down around 20% from the highs. And at this point, we did not know if the markets were going to continue going up or if they were going to crash again, so there was a lot of hesitation for a lot of people investing into the S&P 500. Now this video is surprising, or maybe it's not surprising to you, but we can see a big difference between lump sum investing and dollar cost averaging. So over the past 120 days, that's almost 4 months, I have invested a total of £1,200. Now if I had £1,200 back on the 12th of May, I could have decided to lump sum it then or spread my money out £10 every single day. In fact, I had more than enough cash to do that, but I wanted to see how dollar cost averaging every single day would compare to just lump summing it. Now, as always for these videos, I use the Trading 212 platform, and if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Now, alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received your free fractional share, then all you have to do is to press the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code, and in this section just enter the code JUBAIR and you should receive a free fractional share. Now, if we look at the actual S&P 500, by actual I mean the original index whereby all these other funds try to track it. The original index is in points, and if you didn't know already, the S&P 500 is predominantly US based. It's essentially the top 500 plus minus about 10 or 12 companies of the USA. Now, a lot of people refer to this as the US economy. It's obviously not the entire US economy, but it's a good amount of it. Now, when we look at this original index, we can see that we are clearly at all-time highs. So the S&P 500 has been performing absolutely greatly. Over the past year, it is up by over 18.7%, and year to date, it's already up by over 10%. Now, like I mentioned in the beginning, there was a quick flash crash. We saw the S&P 500 drop by around 20%. However, since then, the S&P 500 has very quickly recovered. There was a staggering amount of people who thought the S&P 500 wouldn't recover, but it took merely weeks for it to recover from those lows. And then shortly after that recovery, we can see we are up by over 5%. However, things in the SPXL look a bit different. As you can see, we are still not at all-time highs. All-time highs were made on the 13th of January. However, even today, we are not seeing this all-time high. Unfortunately, this is what happens when you invest in the UK. Because the S&P 500 is in dollars, you have essentially two choices: to use an ETF that will take your pounds, invest it into dollar and then convert it back, or use a hedged version of the S&P 500. Now, as you can see, this is an example of a hedged version of the S&P 500. Now, when I say hedged, I mean currency hedged. You can see currently with this fund, we are definitely at all-time highs today. When we compare the performance of this with the performance of the actual S&P 500, they're very similar. However, do bear in mind, if you want to go for a currency hedged ETF, it's going to cost you a lot more. Not only that, but currency hedging over the long term, if you are a long-term investor, may make absolutely no sense. You're probably going to end up paying more in fees, but who knows what the currency differences between the pound and the dollar will be then. So essentially, over the time that we've been invested, the pound has strengthened against the dollar, and unfortunately that means we aren't seeing the all-time highs here. But anyway, as you can see, my first purchase was on the 12th of May 2025. I bought my shares for an average of £10.74. So let's compare lump sum investing as opposed to dollar cost averaging £10 every single day. I think the results here will shock you. Even though 120 days seems like a long time, I think in the grand scheme of things, it's not that long. So if I had invested £1,200 instead of spreading it out over 120 days, I would have received 116.69 shares. Now we're going to use the amount of shares we have because it's the easiest comparison. Later, I will show you exactly how much we would have had from lump sum investing as compared to the £10 every single day. So I created a custom pie on Trading 212, called it S&P 500 £10 daily. And as you can see from my net deposits, so far I've invested £1,200. So that's 120 days of investing £10 every single day. So in order to do this, I have enabled auto invest on Trading 212. Now what this means is £10 is taken out from my cash every single day, including the weekends. However, because the weekends the stock market is closed, basically on Monday about £30 is put in. If Monday is a bank holiday, on Tuesday I believe £40 is put in. You can see over the past month and since my last update, I do this update every 30 days. So stay tuned and also go back and check the other videos to make a nice comparison. Over the past 30 days, there really isn't anything notable that happened. We did get a few scares that the S&P 500 was going to crash, but like we've come to expect from the S&P 500 in recent years, signs of a crash haven't really led to any sort of long-term crash. So here are the results. So since investing into this fund over 120 days, investing £10 every single day, so we are up by around 4.87%. In terms of pounds and pence, that is a positive £58.38. Now essentially that's around 5 to 6 days worth of daily deposits for free. Obviously we haven't sold out yet. This is all unrealized profit, so we can't really say that. Now 4.87% over 120 days is actually not bad at all when you consider the average savings account is giving around 3 to 4% over the span of an entire year. But of course with the stock market you are risking your money. Is 4.87% really enough over that time period? It is up to you to decide. And obviously past performance is not going to dictate what you're going to get in the future. Now in order to make our comparison between lump sum investing and dollar cost averaging, we need to find out how many shares we have today. Now through investing £10 every single day, we have collected 106.8 shares in the SPXL. Now this seems all well and good until we actually start comparing it with the lump sum example. Now instead, on the 12th of May, if I had invested £1,200 into this fund here, the SPXL, I would have had 116.69 shares. Now that is about 10 entire shares more I would have had over that 120-day period. Now 10 shares is a huge amount, so let's do the math. So currently my total is £1,258.38. Instead, if I had lump summed, my shares would now have been worth £1,374.84. That is a difference of £116.46. Now essentially that's 11 to 12 extra days worth of daily deposits for free had we done the lump sum. Now to put this into perspective, our dollar cost averaging or pound cost averaging yielded us 4.87%. Now if we had lump summed this same amount on the 12th of May, via my calculations, we would have had a 14.57% return. Now that's basically around 10 extra percent return we would have got over the same time period. Now studies do tend to show that lump sum investing does beat out dollar cost averaging over the long term. Now one basic idea is that as investors, we expect the stock market to increase as a function of time. Now, if we expect something to increase over the long term, there may be some short-term fluctuation, but over the long term, it should increase. So why not just lump sum now and benefit from the increase? Dollar cost averaging or pound cost averaging has its benefits. It's a lot more ease of mind because if you lump summed at the wrong time and then a stock market crash happened, it could feel really bad.